what's the right investment structure, or what investment structure should you use? Now, this table I use throughout most presentations that I do, and it's the first point of call. If you have a sum of money to invest, then first thing you need to decide, do I invest in my individual names, joint names, a trust, a company, or in superannuation? And superannuation is divided into two phases, the accumulation phase and the pension phase. Now, any asset that you invest in, generally it has income and or capital gains. So if you think about an investment property, it derives rent, which is the income, and hopefully it goes up in value as well, which is the capital gain. If you invest in your individual names and you're on the average wage, so earning between $37,000 and $80,000, you're paying 30% tax. So if the asset derives income, then you're going to lose 30% of it, or 31.5% of it, in tax. Usually there's better ways to invest. If you've got a lower tax rate, like zero, then it's probably a good idea to invest some money in your own name. Can have some effects on things like family tax benefit, Part B, etc. But the majority of people are in this 30% tax bracket. That's where the average wage sits. If you invest in joint names, then any income is just split between the two of you. And if you invest in a trust, then you have the flexibility to potentially distribute assets to a range of beneficiaries, including your church. So if you do have some assets that you want to maintain outside of superannuation, for example, it can be a tax-effective way to distribute income to your church or charitable organisations, because you can distribute to those non-profits, and they don't pay any tax on it. And you don't pay it because you're distributing it to them. So a trust can be beneficial there. A company, we generally never recommend investing in growth assets through a company because it can have some tax deferral benefits, but generally there are other options that work better. And there's no discounting with the capital gain. You don't get a 50% discount on the capital gain if you hold it more than 12 months. So that's another drawback of investing through a company. In superannuation, in the two phases, so in accumulation phase where you're putting money into the fund, the tax on the income is 15%, and on capital gains held longer than 12 months, it's 10%. And in pension phase, there's no tax to be paid at all on the earnings. You do actually get dividend imputation credits back, so that can be of benefit. And additionally, if you're over 60 years of age, then the money that you draw from it is totally tax-free as well. So the first thing you do is work out what your investment structure is, and don't forget that superannuation is not actually an underlying investment in itself. It's another structure, and then you can choose the investment that you want within that structure.